evening, everyone. 5 p.m. on the clock. It's time to kickstart ET Now's Rise with India Prime Time Hour. I'm Mubina Kapasi, and as always, we will do it with the Money Show, your one-stop shop for everything to do with money. Today on the show, we've decided to talk about bond yields. A very complicated topic, but it's something that can help you make money. How? That's what we're going to talk about. Additionally, gilt funds, what are they? Well, firstly, they've made a lot of money for investors in the last 1 year. The question is, should you still buy them? Next, for all the investors in the Axis Large Cap Equity Fund, you'll want to stay tuned in because the fund manager of that fund, Jinesh Gopani, is going to be joining us to share his strategy on our Meet Your Fund Manager segment. Remember, Axis Large Cap Equity is the largest ELSS fund so far. And finally, on our Spend with TMS segment, Pakistan has opened up its airspace for commercial airlines, which means fares especially to Europe and America have dropped. Know which destination flights prices have dropped on our Spend with TMS segment. And of course, as always, our phone lines will be open over the course of the next 1 hour. So keep your questions and queries on personal finance, on travel ready, and we will answer them. For now, the top headlines. Autonomy debate reignited. Sources suggest SEBI chief has written to the finance minister seeking a review of budget proposal that mandates transferring surplus funds to the government. Ajay Tyagi says the move undermines SEBI's financial autonomy. Markets fall with a thud in the last hour. The Nifty shuts shop below 11,600, while the Sensex gives up over 300 points. PSU banks bleed. Metals and auto as well struggle. No measures announced by the government to ring-fence overseas investors from the tax jolt. The government introduces amendments to the finance bill without making any changes in the proposal to hike taxes for FPIs. It's an ET Now exclusive. Flipkart founder Sachin Bansal looks to add the mutual fund business into his cart. Sources tell your channel that Bansal may be in advanced talks with the Goyals of Z Group to buy out SL Mutual Fund and transform it into a tech-backed platform. Some light at the end of the tunnel. Committee of Creditors for Jet Airways hopes to get 3 to 4 names participating in the auction for the troubled airlines. Sources tell ET Now the Aviation Ministry may hold back some slots for the bidder who wins Jet. Netflix plans to introduce cheaper subscription plan for India. The idea comes after a company added fewer subscribers than expected in the second quarter earnings. Reports suggest the plan could be priced at just 300 rupees. High drama in the Karnataka Assembly. Chief Minister H.D. Kumaraswamy moves the trust motion, launching a scathing attack on the BJP and blaming it for causing political instability. Congress JDS combined claims they have the numbers, even as rebels refuse to budge on resignations. India ups the ante against Pakistan a day after the ICJ ordered Pakistan to review death penalty for Kulbhushan Jadhav. S. Jaishankar calls up Pakistan to release and repatriate Jadhav. Foreign Affairs Ministry says detention of Jadhav is now illegal. Well, there you have it, a wrap of all the top stories that you should know. But like I said, today's day is going to be all about personal finance, and the topic that we want to talk about is bond yields. What are they? And did you know that when a bond yield moves, you too have the opportunity to make money? That's what we are going to be discussing over the course of the next 20 minutes. So if you have any questions on personal finance, on debt funds, on gilt funds, call in. The number will shortly appear on the top of your screens. And of course, in the meanwhile, we will be answering all the email questions we have received today on the show. And to do that, we have with us Mr. Hemant Rustagi, and he is going to be joining us to talk about all of this. Mr. Rustagi, thank you for joining us on the Money Show. It's a pleasure having you with us as always. Let's talk about bond yields. In fact, I'm just going to pull up how bond yields have moved. what it is at today and what it was approximately 2 years ago, and it's quite a marked difference because of the RBI stance, because of what's happening in terms of the global economy. And there you have it. In September 2018, in fact not even 2 years, just about a year ago, 8.13, and now it's fallen to 6.38. It's a great money-making opportunity, but I think for all our viewers out there who don't know exactly, I mean, prima facie, it looks like, hey, if it's fallen, however I made money, right? So to start with, if you could just give our viewers a briefer on how yields and bonds prices move inversely.
As you rightly mentioned, what happens is that equity market, when the markets go up, investors become very happy saying that, okay, this is the time to make money. But it works the other way around as far as the bonds are concerned. That's because, there's an inverse relationship between the bond yields and the bond prices. So typically what happens is when the yields go down, as we just saw that they've almost, from 8.18, they've come to 6.38. What typically happens when the bond yields come down, the new bonds offer you less rate of interest, and the existing bonds which are already there, which are offering higher rate of interest, are more in demand. So what typically happens is that everyone wants to buy the bond which are offering higher rate of interest. So the bond prices move up. That's where the bond fund, the gilt funds actually benefit from that. So typically what happens is because they already are holding bonds in their portfolio, the NAV starts moving up. That's why we are seeing actually, if you see the gilt funds especially have given 16-17% return in the last 1 year. So it's mainly because of the inverse relationship which is there between bond yields and the bond prices.
So by that argument then, Mr. Rustagi, we should see even debt funds, which basically invest in all these bonds and corporate securities. By that argument, debt mutual funds as well, I'm sure they must be praying for this sort of an equation to come by then. So, but of course, there are all these overbearing factors as well in debt mutual funds, and that's of course speaking of the DHFL crisis, RLNFS crisis, which we as well on the Money Show have covered very widely. So in such a scenario, what should debt mutual fund holders do?
Well, that's a very interesting question that you're asking. See, what typically happens, like I said, the gilt funds have shown fantastic return over the last 1 year.
That's of course
the debt funds haven't shown because there are two things. While I've explained that there is an inverse relationship, the impact of the bond yield, the bond prices, will depend on what is the maturity duration of the security. So typically what happens when you talk about government securities, the maturity could be 10 years, 15, 20, 25 years. Whereas if you look at the bond fund, okay, depending on the kind of bond fund, even if you're in a duration fund, the average maturity is going to be 5, 6, 7 years. So clearly, even if the impact is there, impact won't be exactly the same which you see in a gilt fund. And that's exactly the reason why you're seeing the gilt funds right at the top of the table.
Yeah. So the duration of the bonds that are held by the fund, that matters. Gilt funds, which by the way for our viewers are those funds that invest in government securities. So obviously they have zero credit risk, but they always have that interest rate risk, which we will come to shortly. These are what the gilt funds have done. And take a look, Mr. Rustagi, I mean 18%, 17%, these are the kind of returns, these gilt funds have given and from a 1 year time horizon. So that's the reason why perhaps these gilt funds have done well. But folks, like I said, Mr. Rustagi is here and it's your golden chance to get your questions and queries answered by him. 24990388, and in the meanwhile we will take up some email queries, and we've received a lot of them. So let's kickstart our Ask the Money Show segment. Our very first question we have received is from Dipankar Nath. He asks, I wanted to know about the expense ratio on schemes. What does it mean and what should be the ideal ratio? Very often we see this in our fact sheets of these mutual funds, but we don't understand what that means. So what is an ideal ratio and how is it calculated? What all does it include?
Sure. I think it's very important for any investor who invests in the mutual fund to know what the expense ratio is. As he said, he wants to know about the expense ratio, which is also known as TER, total expense ratio, which is basically charged to the fund on an annual basis. The best thing about these expenses is that SEBI has prescribed how much can be charged, how much can be charged for each category of fund. Now, let me explain that there are two categories of funds here. One is the equity fund, the other one is a debt fund. Equity funds are all those funds which invest 65% more in equity. Rest all are considered as debt fund. So there is a limit for each category of fund. Second, SEBI has also prescribed what can be charged as expense. It's not that the AMC can decide to charge anything and everything in that. Now, what are the major expenses that are charged in the TER? One is the investment management fee, which is charged by the AMC for managing your fund. There are custodial charges. There are investor communication. There is a broker which is paid. Okay, so these are the expenses which can be charged. Now, what typically happens in an equity fund, the maximum that a fund can charge you is 2.25%. And that happens only in the first slab of 0 to 500 crore. As the AUM of the fund increases, the expense ratio comes down. So the moment an equity fund reaches 50,000 crore and more, Okay, the cap is 1.05. See, from 2.25, it comes to 1.05. Similarly, if you look at the debt fund, the maximum that they can charge is 2%. And when they reach 50,000 crore, they can charge 80 basis point. There'll always be a difference of 25 basis point between an equity fund and a debt fund. So like I said, this is important for every investor to know how much is being charged. The second important thing is the NAV that you see is post charging of these expenses. So they are basically net of expenses. So when you look at your NAV, when you look at the return, they're post expenses. Everything has been taken care of. This is what comes in the hand of investors.
The investor, yeah. So it's a final picture, basically, the NAV. I just have one question, Mr. Rustagi. When you talk about active funds and passive funds, I'm assuming that active funds will obviously have a higher expense ratio. But by how much? I mean, is it substantial? Because, you know, very often investors wonder that what they are paying for these active funds, is the active fund actually able to generate that alpha, which obviously passive or index funds can't?
But that's an important issue. If you look at the passive fund, I think the cap is at 1%.
Okay.
So clearly the expenses are, so one of the benefit of investing in a passive fund is that because you're not using fund manager expertise, the fund manager is not really using his experience, his knowledge, his strategy.
Right.
He's just trying to mimic what is there in the index. So obviously the charges are much lower. So 1% is what you pay. But second important question that you raise about whether the enough alpha is being generated by the fund manager because I'm charging more. See what typically happens if you see the last 1 year, okay, because the market has been so narrow in terms of only 6 or 7 stocks have done well.
Yeah, the breadth
so
has been
clearly what has happened, only the large cap funds have done well, and even there, if you compare that with ETF, okay, ETFs are done better than the actively managed fund.
Right.
But then that scenario will change once the market becomes more broad based. Once you see the mid cap and the small cap stocks doing well, you will see the multi caps doing better, you'll see small cap and mid cap doing better. But obviously till that happens, there is always going to be a period where you'll see that the passively managed funds are giving you better return. But it does not mean because they have done well for the last 1 year that you change your portfolio entirely to passive fund. I believe in a market like India, you still have few years where you will see the actively fund managers will be able to generate higher return than the passive managed fund.
Okay, all right. Let's move on to our next question then on our Ask the Money Show segment. Kruti Desai has sent in a question. She says, I'm an NRI, I'm 28 years old and looking to invest in mutual funds for wealth creation, and also she wants to know, and for retirement, she wants to know, please suggest some good SIPs. She can invest 10,000 rupees on a monthly basis, can also increase it on a year-on-year basis. Her risk appetite is more or less moderate. So first time investor, 28 years, so she's still young and she's an NRI. So what would you recommend she start off with? Unfortunately, she hasn't given what her current salary or any other financials are, but she has said that she's looking for wealth creation and retirement. So she wants to invest for the long haul. What would you recommend?
Well, assuming that the fact that the intent is to invest for the long run, and the fact that intent is also to invest through SIP, which I think is the best way for someone who wants to accumulate money over a period of time. And second, because it brings in, brings in discipline in your investment process. Second is we've seen the volatility in the equity market. So how do you tackle the volatility is by sticking to making investment on a monthly basis. And third important thing which she mentioned very clearly is that she wants to increase the SIP amount by 1,000 rupees every year. Which again, I think in terms of strategy, she is perfectly all right. Because the intent is to invest for the long term, she should be starting with well-diversified equity funds. So I'm recommending 3 funds for her. One in the multi-cap category, especially the fund which has a higher exposure to large cap right now, which is Kotak Standard multi-cap. The second is Reliance Large Cap Fund, is one of the best performing large cap fund. And the third is Access Mid-Cap Fund. I believe that there has to be good exposure to all the 3 segments of the market. But since she is the first time investor, I'm asking her to stay away from the small cap funds right now. So maybe include one mid cap fund in that. And the allocation should be 4,000 in a multi cap and 3,000 each in a large cap and a mid cap. So I think that's how she should begin. And there is no need to have too many funds in the portfolio. It's not that when she's increasing by 1,000 every year, she should be adding one fund. I think these 3 funds for the next 4 or 5 years are good enough. It's only when the amount of investment increases substantially is where she can think of actually including a small cap fund in the portfolio.
Okay, all right. And funds, mutual funds itself are a diversified product. So there's no point of diversifying more by buying more and more mutual funds. You're just going to increase, I think, your costs,
exactly.
etc.
Each fund will have 40, 50 stocks. I mean, how many stocks do you want in a
And
portfolio?
there'll be an overlap as well, I assume, in many
exactly.
cases.
That's the reason I
yeah.
said large cap, multi cap, and
And
a
small,
mid cap.
mid-cap. All right. Okay. So, Kruti, I hope we've helped you kickstart your SIP and investment journey, and we wish you good luck for that. Okay, moving on. Let's take up our next question, which will appear on your screens in just a bit. We have Mr. P. Bobby, who has sent in a question. He says, are balanced advantage funds better than equity funds? Mr. Rustagi?
Well, I think both are different categories.
Yeah.
As the name suggests, equity fund is a fund which invests 100% into equity.
Yeah.
Maybe they keep something in cash or some debt securities. The balanced advantage fund, on the other hand, is actually a hybrid fund which invests in a combination of equity, arbitrage, and debt. So clearly, it depends on what is the suitability of as per your requirement. It's not that equity fund is better or a balanced advantage fund is better. Both have their pros and cons of investing in them. So if your time horizon is longer, and if you can take the risk of some amount of volatility to get higher return, equity funds would be ideal for you. But if your time horizon is, let's say, 3 to 4 years, or if you are someone that who do not want a lot of volatility in your portfolio, then the balanced advantage fund would be best. The important thing to remember here is that balanced fund invests in a combination of equity and arbitrage, as I mentioned, in a manner that the total of these two is more than 65%. So they become eligible for taxation for equity funds. So in terms of taxation, both are same. But because there are arbitrage, equity and debt, the volatility is lesser, the potential of return also is lesser. So clearly, as I mentioned earlier, both are great categories of fund, but it clearly depends on what your time horizon is or what your risk profile is, that you can choose which is the best for you. So it's not that A is better than B or B is better than A. It all depends on your own requirements.
Okay, well, that of course is Mr. Rustagi's view on which kind of fund is better. Okay, we have Mr. Sunil Verma, who's joining us live on the phone line. Good evening, Sunil. Thank you for calling us. What's your question? Sunil, if you can hear me, what's your question?
Yes.
Yes, good evening, sir. What's your query for Mr. Rustagi?
Myself, Sunil Sharma. My query is, I am holding 1,000 shares of GAIL, Gas Authority of India Limited.
Okay, you know what, Mr. Verma, I'll have to pause you right there. Unfortunately, we don't take stock queries, but I will request you to connect with us on Buy Now, Sell Now every day at 11 a.m. You can just tweet to us on ET Now and we will answer your query. But yeah, this show is, of course, a holistic personal finance show. We talk about mutual funds. And you know what, I'm going to go ahead and take the next question, which we have received via email. It is from Raja Prem Kumar P. He says that he has been for the last few years investing in the following direct plan SIPs, 10% annual top up, which I think is a fair practice to do. And let's pull up the funds that he has invested in, which he has been investing in. First up, there's the ICICI Prudential Blue Chip, where he has put in approximately 4,000 rupees. We also have the Franklin smaller composite, where he has put 2,000, and the Motilal Oswal multi-cap, he's put in 3,000 over there. Okay, the portfolio should, I think, come up in a bit. But yeah, basically his aim is he's looking to accrue 40 lakh rupees in 18 years. And please suggest if there is any tweaking required. Okay, we have it a bit joggled up. But yeah, basically ICICI Prudential, there's a blue chip, there's a small cap. Smaller comp, I think that's a small cap fund, and there's a multi-cap. 40 lakhs in 18 years, he's roughly putting in 9,000, sorry. So firstly, do you think the amount is enough? Secondly, do you think 40 lakhs in 18 years is perhaps a bit too conservative a target or too small a target?
I think there are 2-3 aspects clearly. If you look at the portfolio per se, there is one large cap, one multi-cap and one small cap fund, which I mentioned some time ago. This is how a portfolio should be built. The only difference is we had recommended a mid-cap fund. Here he has a smaller cap fund, which is fine because the time horizon is 18 years.
Right.
So I think in terms of combination of fund is perfectly all right. Investing in equity as an asset class is again great option because the time horizon is there. Now in terms of whether 40 lakh is going to be enough or not, clearly I don't think after 18 years 40 lakh is going to be enough. But good news for him is that if he continues to invest his 9,000 and increase by 10%, and I assume a return of let's say 12% on an annualized basis,
is fair enough,
he should be having a corpus of around 1 crore 11 lakhs.
Okay, so it will exceed his target.
He will certainly exceed. The key is, I think there are going to be many testing times during the next 18 years.
Of course.
There are going to be time when the markets are not doing very well. There are temptation at times to stop the SIP or start questioning your decision whether you're doing the right thing or not. So I think my advice to him would be that he should stick to his time horizon, stick to his portfolio, continue the investment process irrespective of what happens in the market during that period.
Okay.
He should be able to accumulate 1.11 lakh crore.
So if you're disciplined, if you continue with this top up 10%, you won't get 40, but you will get more than 1 crores. So good job firstly on the fund selection, and stay disciplined and you will turn wealthy. On that note, Mr. Rustagi, thank you for joining us on The Money Show. I hope, folks, with that, we have been able to give you a gist of how you can make fun every time bond yields move. Coming up next, we are going to be talking to Jinesh Gopani, who manages one of the largest CLSS funds, the Axis Large Cap Equity. That's one conversation you do not want to miss. Welcome back. You're watching The Money Show on ET Now. We just had a very interesting conversation with Hemant Rustagi on how bond yields can make you money. And now let's help you out with bond yields. Remember, it's our aim to also educate you so that you are better equipped to handle your own finances. First up, jargons simplified. We are going to take one very difficult word that many people do not understand and try to simplify it for you. Portfolio YTM. This is a very common term that is used especially in the fixed income market. Now, what exactly does it mean? You know, like Mr. Rustagi said, in a particular fund, there are various securities that are held, be it corporate bonds, that's just for an example, Tata Steel may have issued debentures and you're holding it, or maybe it's a government 10-year bond. Now, the debenture from Tata Steel may just be held for 5 years, whereas the government bond will be held for 10 years. Now, what will be the return of that fund if both these securities are held all the way till their maturity? If in case these securities may be sold before they mature, then the return will be different. So that's the reason why a portfolio YTM or a portfolio yield to maturity is an important figure in the world of fixed income markets. Well, moving on to our Mythbuster segment, where we will try and bust the myth that does exist in a particular segment. This time around, it's going to be on gilt funds. Gilt funds, which, like I said, hold government securities, are risk-free. And that's really the case, you know, because when one does believe that they are lending money to the government of sorts, they do tend to be risk-free. However, they are not necessarily risk-free. They always carry an interest rate risk. Yes, the government will not default on its payments. However, like I said, the interest rate is fixed. The government will only pay you a particular interest amount. However, in the market, the interest rate may be higher. That's what an interest rate risk is. The NAV will drop if in the market you're getting a better interest rate, because why then should you invest in a gilt fund which will offer only a particular interest? That essentially is the risk that you do carry when you invest in a gilt fund. Okay, I hope this has made you a bit wiser from here on, but now here is a treat for all the investors of the Axis Large Cap Equity. It's one of the largest ELSs. In fact, it is the largest ELS as so far in the market. So we decided, let's bring on board Mr. Jinesh Gopani, who is the manager of the Axis Long-Term Equity, for the benefit of the existing unit holders as well as the prospective unit holders. First up, let's go across to Jayesh Khilnani for a wrap of what are the constituents of this large cap fund. Hi, Jayesh.
Well, the fund on radar today is the Axis Long-Term Equity Fund. Let's start off firstly with the performance that this fund has delivered over the last 1, 3 and 5 years. In the 1 year, you can see that it has delivered as much as 7%, and it is the long-term return, which is the 3 and the 5 year return, that the fund has given you about 13 to 15% each. But as far as the portfolio turnover is concerned, or which is also popularly called as the churn of the portfolio, that stands at a little higher on about 60% odd. But the healthy performance that I was referring to in the 3 and the 5 years, it will become evident over the next 2 slides when you have a look at the sector and the stock composition of this particular portfolio that we have. Financials dominate the space at about 44%, followed by IT and consumer names, which combined have a weight of about 25%. Even in the top 5 stocks that we have listed over here, 3 of them belong to the financial space, while you have the odd Pidilite, which also makes it to the top 5 of this portfolio. But with that, let's also welcome in Jinesh Gopani, who manages this fund and is also the head of equities at Axis Mutual Fund. Jinesh, firstly, thanks for taking the time out and speaking with ET Now. Let's begin with what is the basic investment philosophy that you follow while managing this particular fund?
So I think the basic theme is when we started this fund in 2009, the approach was to differentiate something to the investor community because you were 42nd mutual fund who was starting, and how to differentiate yourself from the rest of the pack. And given our experience of doing long-term investing in our earlier organization, the key top management team came together and brainstormed in terms of how to take this on a long-term investing mode rather than taking a daily NAV kind of an approach. And since it's a 3-year lock-in fund, we thought the idea was to have a multi-cap strategy with a view to invest with 3 to 5 years in any stock where you are buying and hold it on for a longer period of time as the business models grow. So idea was long-term investment rather than a very short-term trading approach. Idea is, and we have been doing continuously, is to identify new ideas, new themes which are evolving in India and which can give you higher than average returns from the sector where they are. So the strategy is a growth strategy. The philosophy is the corporate governance plays a very important role. We take a big bet on the management after doing our in-house assessment, and if we go right, then I think money making opportunity is very, very big. So this was the approach we started with, and we are continuing it even at this juncture.
Well, Jinesh, this is the largest ELSS scheme that we have in the Indian mutual fund industry. So what is the management strategy that you follow for this fund?
So there are different types of risk when you invest. So the first risk what we see, as I said, a management risk. In India, with our experience, we have seen that even if the company is good or the sector is good, somehow if you go wrong on the assessment of the management and his intentions of creating wealth, then I think you lose a significant amount of your wealth in those type of management. So management risk is the biggest risk what we try to ascertain and try to ensure that you don't go wrong in this. The other risk is the business risk. So in this disruptive world, whether your business itself will be thriving after 10 years is what the question we ask ourselves and we ask the management. And if we feel that the business is not a scalable business model, then we stay away from it from the larger part of the portfolio construction. The third risk what we see is from the market perspective is the liquidity risk. You might enter into a good stock, but if there is no liquidity in that stock, maybe even after 2-3 years, then I think it becomes difficult for you to exit those stories. So don't go wrong on the liquidity side of the portfolio. As long as we are able to have a balanced liquidity approach in our portfolio, we are okay with that because it's a 3-year lock-in fund. So these are some of the risks we take into account while assessing a company, assessing the management, assessing the business models. And if you go right and if you have a view which is a positive view, then you go and invest in those stories.
Jinesh, also talk to us about the risk management processes and strategies that you adopt for this particular fund.
So see, as I said, our philosophy is simple. In India, we have a land of entrepreneurs. There are many entrepreneurs who are hungry for growth, who are good in corporate governance, relative corporate governance, and who really wants to create wealth for themselves or for the investors. So we try to pick and choose those 1 or 2 names or maybe 3 names from the sector and try to analyze more, do in-house research, channel checks as much as possible. And if we think that the business model is secular, scalable, and can generate higher ROEs as compared to the industry averages, then we invest heavily into that. So the basic strategy or philosophy, I may say, is take bets on the management. Pedigree of the management is very important. Relative corporate governance is a very important part of our parameter to weed out companies. Look for quality and sustainable secular businesses which can grow for maybe next 10 years, 20 years, and ultimately those businesses should generate higher ROEs as compared to industry averages.
One final question, what would you like to advise the fund investors, both the existing ones and the potential customers that you have?
See, I guess the idea is to identify great companies run by great management or great promoters. We feel that if you are able to identify those companies who are growing at a higher than average cost of capital in terms of their return on equity, I think the returns are there to be made. And we have now history of last 10 years in Axis, and also you have history of the other funds as well who are in the market for last 15-20 years, and the returns have been pretty healthy for some of the funds. So I think the idea is do systematic investment. Don't churn the portfolio for the heck of churning the portfolio from one fund to another one. If you are happy with the construction of the portfolio, be with them with a 5 to 10 year view.
Well, that was Jinesh Gopani, Head of Equities at Axis Mutual Fund. But it's time for a short break on ET Now. The Money Show continues with Mubina Kapasi on the other side.
Welcome back. You're watching The Money Show right here on ET Now, and it's time for our Spend with TMS segment. Imagine that you can reach your destination abroad at a shorter time and at a cheaper airfare. Well, that's exactly what's happened, as Pakistan has decided to finally open up its airspace for commercial airlines, which means if you're traveling from Delhi especially, whether you want to go to Europe, to the Middle East or to America, now not only will the duration of your flight be decreased, but the pricing as well will drop drastically. As you can see on your screens, Middle East prices have dropped by 35%. For Americas, it's dropped by almost 15 to 20%. There you have it. Even for Europe, it's dropped almost 15 to 20%. So good news for all our flyers out there. That's what we are going to discuss then today on the show. And for that, we have with us Mr. Sharat Dhal. He is, of course, with Yatra Online. Thank you, Sharat, for joining in on ET Now. I believe a lot of our viewers have reason to rejoice, especially those who have travel plans and were fretting over how this entire restriction would add maybe 2-3 hours extra before they can reach their destination. But all in all, Sharat, which sectors exactly have seen the most drop in airfares thanks to this route now opening up?
Thanks for having me on the show. Well, yeah, it is a bit of a bonanza both for the for flyers as well as for the carriers as well, because the airspace, the Pakistani airspace being closed, added a couple of hours of additional flying time, and that means fuel cost as well. So it was a hit to the airline bottom line, and some of it was being passed on to the customer. And what we are now seeing is that post the opening of the airspace, that some of these airfares have come off slightly, and we expect that this is a process that will continue. What we are seeing is that actually flights to the Middle East, so it particularly impacts the northern areas of the country. and flights from Delhi to, for example, Abu Dhabi have come off to 17,000 from fares of above 30,000. Similarly, fares to North America and to Europe have come off fairly significantly. A flight to London now, you'd get it for about just over 60,000, which was at over 80,000 a week back. Similarly, North America, a flight to New York would now cost you around 82,000 versus over a lakh of rupees about a week back. So a significant reduction in the fares and a great opportunity for travelers to reap the benefits of this.
Well, yeah, just take a look at that chart over there. Delhi to Abu Dhabi, it was 30,000. Now it's just 17,000 rupees. It's certainly a big bonanza for a lot of our viewers out there, and for all those who may have already booked their tickets. Well, unfortunately, you wish you had just been a bit more patient. But yeah, Delhi, London, now 63,000. Unfortunately, it's coming in only after the ICC Cricket World Cup. Istanbul, 24,000, and New York as well. A direct flight is now 82,000. Sharath, there's the other question that I want to ask you about how airfares are trending besides of this entire Pakistan issue. We have Jet Airways, which is obviously not operating. Indigo and Spice are trying to add more and more routes into their plans, but of course they as well have their limitations. Slots, etc. have to be allotted, so on and so forth. So do you think that airfares would still be stable before they could drop further, or do you think they could actually be going higher now that Jet is off the charts?
Actually, we are currently in the off-peak season, and this is the time that typically domestic airfares in particular drop. And we have seen that from the beginning of July, that happening from the beginning of July. And fares have dropped off significantly from what they were in May and June. So there are a couple of reasons. One is that demand is lower as we head into July, August, September. And also what has also happened is that a number of the aircrafts have also additional capacity has come back. Both SpiceJet and Indigo, as you mentioned, have brought in additional aircraft. Some of the jet aircrafts have come back with both Spice as well as Vistara. So we are seeing that additional capacity plus the drop in the demand is actually resulting in the fares coming back to levels which are pretty much in line with what they were last year around this time. So actually, there are a number of people who particularly plan to travel in the off season because the off season typically these destinations are less crowded, the fares are lower, lodging options are more attractively priced. So it's actually a great opportunity for people who don't mind traveling in the off season, people who don't have school-going children, can take a break anytime during the year. For them, it's a great opportunity to actually avail of these off-peak fares and off-peak hotel prices as well.
Okay, yeah, it certainly is for those who don't have kids, etc., and can just take off whenever they want. I suppose this would be a great time for them to travel. But Sharath, where? That's the question, because I know for a fact that July, August, which is usually summer in Europe, gets a little expensive, and of course it's anyway a little too soon to plan that travel. But let's say if someone wants to travel in the later part of August or in September, while prices will be low, which would be a good destination to go to?
So, I mean, the options are plenty at this time actually. If you look at domestically, Goa is brilliant in the monsoons and is very affordable. A 3-star package to Goa of 4 nights, 5 days will cost you barely about 15,000 per person. Kerala would be at around 25,000. Andamans is another great option, which would be in the region of about 30,000. And if you look internationally as well, Thailand is a great option again at about 35,000. The Middle East, Dubai. While it is hot out there, but Dubai has some fantastic options as far as sightseeing is concerned, and with a number of different attractions which are there. and which you can pretty much, you don't have to be out in the heat. And Dubai is also available currently at about 35,000, and I expect that Dubai prices of the packages will drop further as the impact of airfares dropping due to the opening of the Pakistani airspace happens. So lots of options. Bali is another great option. It would set you back by only about 45,000 at this time. So very good options, not so far away from India, and options which are where visa is also pretty easy to come by.
All of them, Thailand, Middle East, Indonesia, all of these are places where you can get visas very easily. And that those numbers that are appearing, of course, on your screen, these are all for 5 days and 4 nights. I think Dubai 35,000 is a pretty mean deal, essentially. But yes, do remember, this is, of course, the advantage of traveling off season. That's roughly in August, September, October. That's when, globally as well, the number of travelers reduce. So if you don't have any restrictions, you should ensure that you take advantage of this off season bonanza of sorts that airlines offer you, that hotels offer you. And this would naturally lead to a reduction in the total budget that you need to take a quick 5-day getaway or a 4-night getaway. Okay, now let's differentiate between abroad traveling and traveling in India. As you can see, of course, Andaman, Kerala, Goa, just 25 to 15,000 is more than enough. Of course, abroad, you need a bit more. So, Sharad, if we have to just differentiate between India and abroad, currency, I think that, would you agree, would be the biggest risk for viewers. So used to saying investors because as we are in market channel. But yeah, for our viewers, do you think the currency risk at this point would be the biggest risk that they would have to handle? Because, in May as well, we've seen that more and more people have been using their dollars only to travel. So do you think currency risk would be a big, the only and one of the biggest risks for international travel?
Well, honestly, I'm not a currency expert or to talk about how the currency is likely to move. But what we've seen is that over the last few months, the Indian rupee has actually been fairly strong and has actually strengthened versus the dollar. So from that perspective, I don't think currency risk is much of a factor. And I think that there are terrific options right now, both on the domestic as well as on the international front. Actually, for somebody who's like I said, not bound by the fact that they have school-going children, the off-season is a great way to explore places without the hustle and bustle that typically is there at the time of the peak season. So in all respects, it's a much more comfortable trip and a comfortable journey for you. And a lot of people we've seen over the years have started moving towards traveling in the off season because it kind of is a much more hassle-free trip for them.
So Sharad, do you have then any travel plans for this off season, or do you have school-going children who obviously will have a very strict schedule to follow?
Absolutely. I have a daughter who's in the 12th, so I'm grounded this year.
Okay, maybe 10 years
but
later
I would have,
when she
if I had the opportunity, I would have definitely headed off. I mean, a weekend in Goa.
Okay, well, maybe a few years later when she'll want to be off with her friends, that will give you some time off as well to perhaps plan a trip. On that note, Sharad, thanks so much then for joining us on our Spend with TMS segment. Like I said, folks, it's a great opportunity to book your tickets for Europe, America. Airfares have spiraled down, and hence we at the Spend Your TMS segment have tried to get you the best deals. On this happy and sunny occasion, you can see clouds right behind me. I will leave it for Nayantara to take forward Rise with India Primetime Hour with Startup Central, where she's going to get you some very interesting insights and also give us a gist of how our managing editor will look in 2049. You want to stay tuned for that.